Something happened to silver this week that almost nobody is talking about correctly. Most of the coverage you have seen frames it as a simple story. Silver went up, then silver went down, tariffs were mentioned, a headline flashed across the screen, and the price moved. That is the surface. That is what a ticker shows you. But underneath that ticker, there is a much older and much more important story unfolding, one that has played out in different clothing many times before in modern financial history. And if you understand it, you will see this moment not as noise, but as a signal. Stay with me for the next few minutes, because by the end, the picture is going to look very different than it does right now. And I suspect it will change how you think about the next several years of your financial life. Let's start with where things actually stand, not with speculation, but with what we can verify. As of this week, silver is trading in the mid-$50 range per ounce, a sharp pullback from the extraordinary high it touched at the start of this year when it briefly spiked above $120 an ounce during a period of acute geopolitical stress. Gold, meanwhile, is hovering near $4,000 itself, a level that would have seemed almost fantastical only a few years ago. And this week, the metals complex has been whipsawed by two forces pulling in opposite directions at the same time. On one side, escalating military tension in the Middle East, specifically around Iran and shipping lanes through the Strait of Hormuz, has pushed oil prices up sharply by some measures around 30% from recent lows. On the other side, that same oil spike is feeding directly into inflation expectations, which is pushing bond yields higher and increasing the odds that the Federal Reserve holds rates higher for longer or even raises them again. Markets are now pricing meaningfully increased odds of a rate hike in the coming months, a repricing that occurred within the span of about a day according to data feeds tracking futures markets. That is an unusually fast shift in expectations. And fast shifts in expectations are exactly the kind of thing that separates informed investors from everyone else, because they reveal what the market believes is actually driving events as opposed to what the headlines say is driving events. Here's the tension I want you to sit with for a moment, because it is the key to everything that follows. Silver and gold are supposed to rise when fear rises. That is the textbook relationship. Geopolitical shock, safe haven demand increases. Precious metals rally. And indeed, we did see that dynamic play out earlier this year when metals soared to historic highs amid an environment of acute uncertainty. But right now, in this very week, we are watching the opposite happen. Fear is rising, war risk is rising, oil is spiking, and silver is falling. Why would that be? If you can answer that question correctly, you understand something that the vast majority of retail investors, and frankly a good number of professional ones, do not fully grasp. And that is where we are going today. Before I go further, I want to ask you something, because I think it matters, and because I am genuinely curious what this audience looks like. Comment below and tell me where you are watching from, and tell me whether you personally hold gold, silver, or cash right now as your primary store of value in uncertain times. I read these comments, and over the years I have found that the composition of an audience like this one tells you something real about where sentiment sits in the broader public, which is itself a piece of the puzzle we are assembling today. Now let's build the foundation, because you cannot understand what is happening to silver without first understanding the machinery that sits underneath it. And that machinery is monetary policy. At the center of the global financial system sits the Federal Reserve, the central bank of the United States, whose primary tools are the setting of short-term interest rates and the management of the size and composition of its balance sheet. When the Fed raises interest rates, it is in the simplest terms, making it more expensive to borrow money and more rewarding to hold cash or short-term government debt. This has a cascading effect throughout the entire economy. Mortgages become more expensive, corporate borrowing slows, consumer spending tends to cool, and importantly for our purposes today, the opportunity cost of holding a non-yielding asset like gold or silver goes up. Precious metals do not pay you interest. They do not pay a dividend. They simply sit there, and their value comes entirely from scarcity, from trust, and from what they represent as an alternative to paper currency. So when interest rates rise, holding a barren asset like silver becomes relatively less attractive compared to holding a bond that pays you 5, 6, or 7% a year. This is why higher rates almost mechanically put downward pressure on precious metals prices, all else being equal. But all else is never actually equal. And that is where the second half of the picture comes in, which is inflation. Inflation is at its core the erosion of the purchasing power of a currency over time. When a government and its central bank allow the money supply to grow faster than the output of real goods and services in the economy, each unit of that currency becomes worth less. and prices measured in that currency tend to rise. Precious metals have functioned for thousands of years across dozens of civilizations as a hedge against exactly this kind of erosion. Because unlike a dollar, a euro, or a yen, gold and silver cannot be printed into existence by a central bank. Their supply grows slowly, constrained by the physical reality of mining and refining, not by a policy decision made in a boardroom. This is why historically periods of high or rising inflation have tended to coincide with strength in gold and silver prices, and periods of falling inflation or aggressive central bank tightening designed to fight inflation have tended to coincide with weakness. So here is the tug of war happening right now made explicit. Rising geopolitical risk and rising oil prices are pushing inflation expectations higher, which is bullish for metal snorts in the classic sense because it signals currency erosion ahead. But that same inflation risk is causing the Federal Reserve and traders who anticipate the Federal Reserve's next move to price in higher interest rates to fight that inflation. And higher interest rates are bearish for metals because they raise the opportunity cost of holding a non-yielding asset. Silver in this moment is caught directly between these two forces. And what we are witnessing in the price action this week is the market trying to figure out which force wins in the near term. The immediate answer, based on where prices have moved, is that the interest rate fear is currently winning out over the inflation fear. That is a meaningful piece of information because it tells you the market currently believes the Federal Reserve will act decisively against inflation rather than tolerate it, at least for now. Let me widen the lens further because there is a longer arc here that connects to something economists call the debt cycle. And once you see this pattern, you will start noticing it everywhere. Modern economies, in the United States in particular, have accumulated debt at a scale that is historically unusual. Government debt, corporate debt, and household debt have all grown substantially relative to the size of the overall economy over the past several decades. This matters because heavily indebted systems behave differently than lightly indebted ones. When debt levels are low, a central bank can raise interest rates aggressively to fight inflation without causing catastrophic damage because the cost of servicing that debt for governments, companies, and households alike remains manageable. But when debt levels are very high, every increase in interest rates translates into a much larger increase in the actual dollar cost of servicing that debt. Interest payments on government debt begin to compete directly with spending on everything else. This creates what some analysts describe as a kind of policy trap where the central bank wants to raise rates to fight inflation, but doing so risks destabilizing the ability of the government or heavily indebted corporations to service their obligations. Historically, economies caught in this trap have often resolved the tension not through outright default, but through a slow, sustained period of inflation that erodes the real value of the debt over time, essentially paying it back with currency that is worth less than the currency that was originally borrowed. This is sometimes referred to as financial repression, and it has happened before, most notably in the years following the Second World War, when many developed economies carried debt loads comparable to, or in some cases larger than what we see today. And inflation combined with capped interest rates quietly reduced the real burden of that debt over roughly a decade. If that historical pattern rhymes with today, and I want to be careful here to say this is a possibility worth understanding rather than a certainty, then the long-term direction of monetary policy is likely to favor at some point a return to easier money, lower real interest rates, and a tolerance for inflation running above official targets, even if the near term includes periods exactly like the one we are in right now, where the Fed holds firm, or even in further to manage a specific shock. This is precisely why gold and silver have behaved the way they have over the past several years. The extraordinary rally that took both metals to record highs earlier this year was not simply about a single headline or a single war. It reflected a slow, multi-year recognition among sophisticated investors and notably among central banks themselves that the long-run trajectory of major currencies is one of gradual debasement, even short-term policy moves in the opposite direction. And this brings us to one of the most important and least discussed threads in this entire story, which is the behavior of central banks as buyers of gold and increasingly as participants in the broader precious metals conversation. Over the past several years, central banks around the world, particularly in emerging economies, have been accumulating gold reserves at a pace not seen in decades. This is not a speculative trade for these institutions. Central banks are not trying to time a quarterly earnings report. They are making multi-debt allocation decisions about the composition of their national reserves. And the fact that so many of them have chosen to increase gold holdings tells you something important about how the institutions that sit closest to the plumbing of the global financial system view the long-term durability of paper currencies, including the US dollar. When the people who literally create and manage currency are simultaneously diversifying away from currency and into a metal that cannot be created by policy decision, that is a signal worth taking seriously, regardless of what happens to the price in any given week. Now, let's talk about currency strength, because it is the third leg of this stool, and it is often the most misunderstood. The US dollar operates as the world's primary reserve currency, meaning it is the currency most commonly used for international trade, for pricing commodities like oil, and for holding as reserves by foreign governments and central banks. This gives the dollar a kind of structural strength that other currencies do not enjoy. But it also means that global demand for dollars and the relative strength or weakness of the dollar against other currencies has an outsized effect on the price of commodities priced in dollars, including gold and silver. When the dollar strengthens, commodities priced in dollars tend to become more expensive for buyers using other currencies, which can dampen demand and put downward pressure on prices. When the dollar weakens, the opposite tends to occur. Right now, the same forces pushing interest rate expectations higher, namely persistent inflation concerns tied to energy prices, are also tending to support the dollar in the near term, because higher expected rates make dollar-denominated assets more attractive to global capital-seeking yield. This dollar strength compounds the pressure on silver that we already identified coming from rate expectations, creating a kind of double headwinds in the immediate term, even as the longer-term debt and currency debasement thesis continues to build in the background. I want to pause here and bring in a story, because numbers and mechanisms only take us so far. Understanding markets also requires understanding human behavior, and human behavior is where fortunes are actually made and lost. Consider someone we will call Margaret Chan, a 58-year-old former hospital administrator who retired 2 years ago with a modest but comfortable portfolio. In the early part of this year, as silver and gold were making headlines with their historic run to record highs, Margaret watched friends and former colleagues talk about the gains they were making in precious metals, and she felt a familiar pull, a mixture of excitement and anxiety. The fear of missing out layered on top of a genuine concern about protecting her retirement savings from inflation. She moved a significant portion of her portfolio into silver at the peak, near that January high above $120 an ounce. Convinced that the rally still had further to run in the months since. As silver pulled back sharply toward the $50 range, Margaret watched nearly half of that specific allocation's value evaporate on paper. And she has spent recent weeks anxious, checking prices multiple times a day, wondering whether she made a catastrophic mistake. The lesson in Margaret's story is not that silver is a bad asset. It is that buying an asset at the emotional peak of a narrative driven by the fear of missing out, rather than by a disciplined view of value, is one of the most reliable ways to experience unnecessary pain, even when your underlying thesis about the asset may ultimately prove correct over a longer horizon. Now, consider a very different story, that of David Alvarez, a 41-year-old small business owner who began allocating a fixed percentage of his savings into physical silver and gold nearly 4 years ago, well before the recent surge in prices, not because he was trying to predict a war or a Fed decision, but because he had studied the history of currency debasement and decided he wanted a portion of his wealth held outside the traditional banking and currency system as a form of insurance. David did not sell during the parabolic rise earlier this year, and he has not panicked during the recent pullback either. His average purchase price across 4 years of steady accumulation sits well below where silver trades today, even after this correction. And his emotional experience of this volatility has been almost entirely different from Margaret's. Not because he is smarter or has access to better information, but because his process was built around a long-time horizon and a fixed discipline rather than around reacting to headlines. And a third story, that of Priya Nair, a 33-year-old software engineer who has never owned any physical precious metals at all, and who has instead kept the majority of her savings in cash and short-term treasury instruments throughout this entire period. Priya has watched the volatility in gold and silver with a mixture of relief and regret. Relief that she has not experienced the swings Margaret experienced, but regret that she missed years of substantial appreciation in an asset class that over the medium term meaningfully outpaced the interest she earned on her cash holdings. Priya's story matters because it illustrates that staying entirely in cash, while it feels safe and while it does protect you from short-term price swings, carries its own quiet risk, the risk of purchasing power erosion over time, if the broader currency debasement thesis continues to play out over the coming years. Three people, three very different outcomes, and none of them wrong or right in some absolute sense, because none of us actually know the future with certainty. What separates their experiences is not the asset they chose, but the process, the time horizon, and the emotional discipline behind the choice. This is a good moment to talk about why our brains behave the way they do in situations exactly like this one, because there is real biological psychology underneath what Margaret, David, and Priya experienced. And understanding it is one of the most practical tools you can carry into your own financial decisions. Human beings did not evolve in an environment with futures contracts and interest rate decisions. We evolved in an environment where rapid, instinctive reactions to threat and opportunity meant the difference between survival and death. The part of the brain most responsible for this, the amygdala, processes perceived threats extremely quickly, often before our more deliberate analytical prefrontal cortex has a chance to fully evaluate the situation. When we see a price falling rapidly, our brain can interpret that as a threat in a very similar way to how our ancestors' brains interpreted the sudden appearance of a predator, triggering a stress response that pushes us toward an immediate reaction, often selling even when a calm analysis would suggest holding or even buying. Conversely, when we see a price rising rapidly and hear stories of others profiting, our brain releases dopamine in anticipation of reward, creating a pull toward participation that can override careful judgment, which is exactly the trap Margaret fell into at the top of the market. This is not a character flaw, it is a deeply wired feature of the human brain. And the investors who perform best over long periods of time are not the ones who have eliminated these instincts, because you cannot eliminate them, but the ones who have built systems and processes like David's fixed periodic accumulation strategy that reduce the number of moments in which they must rely on real-time emotional judgment at all. Before we go further, if you're finding this useful, take a moment to like this video and subscribe, because I want you to stay through to the end. Everything we have discussed so far, the mechanics of interest rates, the long arc of the debt cycle, central bank behavior, currency dynamics, and the psychology behind Margaret, David, and Priya's very different experiences. All of it comes together in the final insight I want to leave you with today. And I genuinely believe it is the most important idea in this entire video. It will make much more sense now that we have built this foundation together, so stay with me. Let's now turn to the historical parallels. Because markets rarely do something entirely new, they tend to rhyme with the past even if the specific details differ. In the late 1970s and into the early 1980s, the United States experienced a period of very high inflation, driven partly by oil price shocks tied to geopolitical instability in the Middle East. A parallel that should feel familiar given what we are watching unfold today. Gold and silver soared during that period. Silver, in particular, experiencing an extraordinary speculative run before eventually collapsing sharply once the company. Federal Reserve under then Chairman Paul Volcker raised interest rates to levels that would seem almost unthinkable today, in the high teens, in order to break the back of inflation. That aggressive tightening caused significant short-term pain throughout the economy, including a sharp recession. But in